For 35 years, one investor had a simple, proven strategy that made him a multimillionaire. But now he's saying that the rise of artificial intelligence is forcing him to rethink absolutely everything. So let's dive into what's changing.
This quote right here is really the core of what we're talking about today. You've got a successful, long-term investor who's basically saying that ground is shifting beneath his feet because of AI. So what exactly was his old strategy, and why is it suddenly under threat?
Okay, so first things first, let's understand the strategy that worked like a charm for so long. We're talking about a 3-decade-long journey here, a path that literally earned him millions of dollars.
He used a classic, and I mean classic, passive investing approach. Just buy an S&P 500 index fund. The idea is brilliant in its simplicity, right? Instead of trying to be a genius and pick individual stocks, you just buy a tiny piece of the top 500 companies in the US. You're automatically diversified, and you just ride the wave as the whole market grows.
And boy, has it been a fantastic strategy. Historically, the S&P 500 has delivered an average annual return of over 10%. You can totally see how this simple, hands-off approach built a fortune. But something's different now.
All right, now we get to the heart of the problem. He calls it the AI concentration problem. The very thing that made the S&P 500 feel so safe and diversified is now being warped by the AI boom. And that's introducing a whole new kind of risk nobody was talking about a few years ago.
And check this out, because this is pretty wild. For every single dollar you put into an S&P 500 fund right now, a whopping 40 cents of it goes into just 10 companies. Think about that. Your supposedly diversified fund is actually incredibly concentrated at the top.
And when you look at the lineup of those top 10 companies, a pretty obvious pattern starts to emerge. If you just set Berkshire Hathaway and JP Morgan aside for a second, what are you left with? A who's who of tech giants all pouring billions into the exact same thing, artificial intelligence.
And here's the kicker. These massive valuations, they're not really based on the profits these companies are making today. They're based on what investors think they're going to earn from AI, way down the road. This creates this powerful feedback loop. The bigger their AI bets, the higher their stock prices go, which gives them a bigger slice of the index, which then sucks in even more money from passive investors like us.
So you might be thinking, well, hold on, why not just use an equal-weighted fund, where every company gets the same tiny slice? And it's a great thought, but it's not a perfect fix. See, those funds have to constantly sell their winners to rebalance, which means higher trading costs, plus you run the risk of what's called negative momentum, where you're selling a stock just as it's really starting to take off.
So, what's the first move in this new strategy? It's simple, looking beyond the United States. To hedge against this massive AI concentration, he's diversifying geographically, all based on one simple, undeniable historical fact. No single country stays on top of the market forever.
I love this analogy. Think of the global stock market like a giant cake. The whole cake is the total value of all stocks, but the size of each country's slice changes over time. Go back to 1900, and the UK had the biggest piece. In the 80s, Japan's slice was exploding. Today, well, the US has the biggest slice by a long shot. But history tells us loud and clear that leadership always shifts.
And this really drives home what you miss out on. When you're only invested in the US, you're completely missing out on global giants that are absolute powerhouses, driving growth all over the planet. A global fund just automatically adjusts to wherever the growth is happening.
Okay, pillar number 2 of the new game plan is all about finding value where other people just aren't looking. So instead of just betting on the handful of giants that are building AI, the real opportunity might actually be with the smaller, more nimble companies that are applying it.
This little grid here breaks down the market into 4 zones, and it's super useful. The big AI players like NVIDIA, they're down there in the crowded zone. Hype stocks are speculative. Old-school, stable giants are defensive. But the real sweet spot, according to our investor, is right here in the overlooked zone. Smaller companies that have fair, reasonable valuations.
Think about it this way. Once any new technology gets good enough and becomes widely available, the price always comes down. The real value, then, doesn't just flow to the companies that spent billions building the tech. It flows to the clever, nimble companies that can use that technology to solve real-world problems more cheaply and efficiently than anyone else.
All right, let's move to the third pillar, building a defense. Look, every huge technological leap in history creates not just winners and losers, but a lot of instability. And that's exactly why this new strategy calls for a much bigger safety net made of gold and cash.
And this isn't just some gut feeling. We're seeing a massive institutional shift toward gold.
It's now officially a Tier 1 asset for banks, on the same level as cash. Central banks across the globe are buying it up at record rates. And you've got major players like Bank of America recommending a bigger allocation to it. The smart money is moving.
And it's not just gold. I mean, if you want a sign, just look at Warren Buffett's cash reserves. We're talking about arguably the most successful investor in history, and he is building a mountain of cash. Why? Well, because right now, he's just not seeing many good opportunities out there that justify the price.
See, holding more cash does two things. First, yeah, it's defensive. It protects you and your lifestyle if the market takes a nosedive. But maybe even more importantly, it's offensive. It gives you that dry powder to go out and buy fantastic assets at a huge discount when everyone else is panicking.
So let's put all these pieces together. What does this new playbook actually look like in practice? The whole point isn't about trying to predict the future, because let's be real, nobody can. It's about being prepared for a bunch of different ways the future could unfold.
And here it is, the whole 5-point plan. He's not totally abandoning the S&P 500. He wants to capture that AI growth, but he's hedging his bets by adding these other layers, diversifying with global stocks, hunting for value in smaller companies, and then building that defensive wall with more gold and more cash.
And honestly, this is the question it all boils down to. The market is going to do what the market is going to do. So the real question isn't whether your prediction for the future is right or wrong. It's whether your portfolio is prepared for a world where you just might be wrong. So, are you preparing or are you just predicting?